Hey everyone, welcome back to JC Project Freedom. If you're new here, this channel is all about building financial independence through smart, long-term investing. Today we're doing a full deep dive on ISEC Healthcare, ticker 40T, a company that most people have never heard of, but one that I think deserves serious attention. I have spent serious time going through 6 years of ISEC's annual reports, from FI 2020 all the way to FI 2025, plus their latest Q1 2026 results. And what I found was genuinely interesting. This is Southeast Asia's largest listed ophthalmology chain, eye care hospitals. And as of the time of recording, the stock is trading at what I believe to be a significant discount to its fair value. Now, before I go any further, this is not financial advice. I'm sharing my own research and analysis. Do your own due diligence before investing any money. With that said, let's get into it. So what exactly is ISEC Healthcare? Simply put, it's a chain of specialist eye hospitals. You or I walk in with blurry vision, or we want LASIK laser surgery to ditch the glasses, or we got cataracts, those cloudy lenses that come with age, and ISEC's team of ophthalmologists treat us. ISEC was founded in 2014 and listed on the SGX Catalyst Board. That's Singapore's junior small cap market. They started with just 4 clinics at their IPO. Today, they have 18 centers across Malaysia, Singapore, and Myanmar. And here's the first thing that really caught my attention. The controlling shareholder is Aier Eye Hospital Group from China. Aier is the world's largest ophthalmology chain, with over 352 hospitals globally and a market cap of nearly $15 billion US. We'll talk more about what that means in a moment. Right now, 190 million Singapore dollar market cap. About 575 million shares outstanding. The key numbers are up on screen. Let's look at how they actually make their money. The business model is refreshingly simple. Patient arrives with an eye problem. ISEC's ophthalmologist sees them, makes a diagnosis, performs whatever treatment is needed, surgery, laser procedure, medication, and charges a fee. That's it. No complicated subscription model. No tech platform. No B2B enterprise sales cycle. Just patients paying for specialist medical care. ISEC has 2 revenue segments. First, specialized eye care. This is 95% of their revenue, 75 million Singapore dollar last year. Cataract surgery, LASIK, glaucoma treatment, retinal surgery, corneal transplants. This is a core engine. Second, general health care, which is 4 GP clinics in Singapore under the JL Medical brand. That's only 5% of revenue, around 4 million Singapore dollars. But here's what's interesting. This segment only just turned profitable in FI 2025 after years of losses. That's a positive sign. Let's look at the numbers. This bar chart shows ISEC's revenue from FI 2021 to FI 2025, 5 consecutive years of growth. From 40.5 million Singapore dollars in FI 2021 all the way up to 79.2 million Singapore dollars in FI 2025. That's nearly doubling revenue in 4 years. The big jump in FI 2022 from 40 to 63 million came from acquiring the Ipoh Eye Group in Malaysia, 2 new centers added overnight. Then steady organic growth through FI 2023 and FI 2024. And in FI 2025, 3 new Perak State clinics contributed their first full year, pushing revenue up another 7% to 79 million Singapore dollars. Now, revenue growth is great, but what really matters is whether the company is making money. Let's check. Where exactly is ISEC making its money? Let me show you the geographic split. Malaysia, 80% of revenue, 63 million Singapore dollars. This is a core engine. They have 16 centers spread across the country. Kuala Lumpur, Malacca, Penang, Johor Bahru, Ipoh, Perak, and even Sarawak in East Malaysia. Malaysia's middle class is expanding rapidly. Private healthcare demand is growing. The ringgit may be weaker than Singapore dollar, but the volume of patients is enormous. Singapore contributes 12.9 million Singapore dollars, about 16% of revenue. Their flagship center is at Gleneagles Hospital in Singapore, one of the most prestigious private hospitals in Southeast Asia. This is a high-margin, stable anchor. Myanmar is small, only 3.1 million Singapore dollars, about 4%. Yes, there's political risk, but ISEC has maintained operations through transition, and there's a new government in place as of April 2026. The upside if Myanmar stabilizes is real, but this is a bonus, not a thesis. Now, here's the most important thing I want you to understand about ISEC right now. This is the investment thesis. In a nutshell, ISEC is building a brand new 14-story medical center in Kuala Lumpur. Their current KL center, which is already their highest revenue site, is bursting at the seams. Patient volumes are exceeding capacity. The new center is 69,000 square feet. That is 2.5 times bigger than what they have today. And critically, they're buying the strata units outright, not renting, owning. They took out a RM50 million bank loan to fund it. That's about 18 million Singapore dollars. Target opening, 2027. If that happens on schedule, I estimate it could add 12 Singapore dollars to 15 million Singapore dollars of revenue per year at full ramp-up capacity. Think about that. They're currently doing 79 million Singapore dollars in total annual revenue. A single new building could add 15 to 20% more. This is the catalyst. Everything in the bull case for ISEC revolves around this one building opening on time and ramping up as expected. If it does, the stock re-rates significantly. If it's delayed, the thesis gets pushed out by 12 to 18 months. Let's talk about the elephant in the room, or rather, the dragon. Aier Eye Hospital Group. Aier is listed on the Shenzhen Stock Exchange. 352 plus hospitals in China. Close to $15 billion in market cap. They also own Clínica Baviera, a listed ophthalmology chain in Spain. These people know eye hospitals. They own 55% of ISEC. That means they're in control. And that's both the biggest asset and the biggest risk. The asset, world-class clinical protocols, training, M&A deal flow. Aier can source acquisition targets for ISEC that ISEC would never find on its own. And strategic credibility. Aier's name on the door is a signal. They don't associate themselves with failures. The risk. Controlling shareholder dynamics. 3 of ISEC 7 board directors are Aier nominees. If Aier ever decided to do something that benefited Aier more than minority shareholders, issue shares cheaply, direct contracts to related parties, there's limited recourse. So far, the track record has been fair to minority shareholders. But this is something to watch closely. One of the questions I always ask when analyzing a company is, why can't a competitor just come in and copy this? For ISEC, there are 4 sources of competitive protection, what Warren Buffett calls economic moats. First, brand and reputation. The ISEC name means something in Malaysian and Singaporean eye care after 12 years. Patients trust it. Referring GPs trust it. That takes a long time to build. Second, and this is the most powerful one, physician scarcity. Malaysia produces only about 30 new ophthalmologists per year. That's 30 for an entire country. Once an eye surgeon builds a patient following at ISEC, patients follow that doctor. The cost of switching, for both the doctor and the patient, is very high. Third, geographic density. With 18 centers across Malaysia, no single competitor matches that coverage. Corporate health clients can sign one contract and cover their employees nationwide. Fourth, the Aier backing. No other Malaysian ophthalmology chain has the world's largest eye hospital group in their corner. That's a unique strategic asset. Okay, let me answer the most basic question. Is ISEC actually profitable? Short answer, yes, and increasingly so. Net profit has grown from 4.5 million Singapore dollars in COVID-hit 2020 to 13.4 million Singapore dollars in FY 2025. That's essentially tripling profits in 5 years. The gross margin is 42%, meaning for every dollar of revenue, 42 cents remains after paying for doctors, supplies, and direct costs. That's decent for a healthcare operator. Operating cash flow was 19 million Singapore dollars in FY 2025. Cash flow is the lifeblood of any business, and ISEC generates it consistently. The balance sheet is net cash. They have more cash than debt. Even with the KL Medical Centre loan being drawn down, they're not under financial stress. Return on equity is 16%. That means for every dollar shareholders have invested, ISEC generates 16 cents of profit per year. For context, many SREITs generate 5 to 7%. ISEC is generating capital efficiently. The one concern, gross margins dipped in FI 2024 and FI 2025. We'll look at why in the next slide, because it becomes the biggest question for the investment thesis right now. Let's talk about the most recent results. Q1 2026, reported in May. This was a mixed bag, and I want to be honest about that. The good. Revenue grew 4% year-on-year to 18.6 million Singapore dollars, the fifth consecutive quarterly growth. Cash on hand is 22.7 million Singapore dollars. No stress. The new KL Medical Centre is on track, and a new joint venture was announced in Batapat, Johor. More on that in a moment. Now the ugly. Net profit fell 11% year-on-year, from 3.1 million Singapore dollars to 2.75 million Singapore dollars. And the gross margin dropped from 45.3% to 41.9%. That's a significant compression. The reason given by management? An additional accrual to doctor remuneration. In other words, they paid their doctors more. But the explanation stopped there. No detail on whether this is a one-time catch-up payment or a permanent shift in the pay structure. This is the number one question I would ask management. Because if doctor costs have permanently shifted higher, then earnings forecasts need to come down by about 10%, and that changes the valuation. I always include a risk section in my analysis, because good investing is about understanding what could go wrong, not just what could go right. The two highest severity risks. First, the doctor pay opacity we just discussed. If gross margins have permanently shifted lower, the earnings power of this company is meaningfully less than what I've modeled. Second, KL Medical Centre delay risk. The whole bull thesis depends on this building opening in 2027. If construction is delayed, supply chain issues permitting whatever, the key catalyst gets pushed out and 18 million Singapore dollars of capital is sitting idle earning nothing. Medium risks. Aier's controlling position. I've covered that. Key person risk at the Singapore clinic. Dr. Lee Hung Ming is a founder and a key draw for patients there. And currency risk. 80% of revenue is in Malaysian ringgit. A 5% ringgit depreciation versus Singapore dollar shaves about 4 to 5% off reported earnings. Myanmar is actually the lowest risk item on my list. It's only 4% revenue, and the new government is in place. Manageable. And now the most important slide of the whole video. What is ISEC actually worth? I ran 3 valuation methods to triangulate a fair value estimate. First, a discounted cash flow analysis using owner earnings. That's net profit plus depreciation, minus maintenance capital expenditure. Discounting at 8.5%, which I think is appropriate for a small cap catalyst-listed stock with emerging market exposure. I get a base fair value of 0.599 Singapore dollars per share. Second, a comparable company analysis on EV to EBIT. The sector median for listed ophthalmology chains globally is around 18 times EBIT. At that multiple, ISEC would be worth about 49 cents. Third, a P/E-base approach. At 20 times earnings, which is reasonable for a growing Southeast Asian healthcare company, fair value is about 46 cents. Blending these 3 methods, 50% weight to DCF, 30% to EV/EBIT, 20% to PE, I get a blended fair value of 0.539 Singapore dollars. The stock currently trades at 0.330 Singapore dollars. That's a 38.8% margin of safety to my base fair value. My minimum threshold is 30%. This clears the bar. Now here's the really interesting part. I reverse engineered the DCF. Ask the question, what growth rate is the market pricing into ISEC at 0.330 Singapore dollars? The answer is only 4 to 5% per year. That's way below the historical 10+% growth this company has delivered. The market is being deeply pessimistic about the KL Medical Centre catalyst. I think that's an opportunity. Let me walk you through my earnings forecast for the next 3 years. FI 2026. I'm forecasting flat EPS at 2.32 Singapore cents. The company is in investment mode. The KL Medical Centre is consuming capital. New clinics need time to ramp. Don't expect a profit surge this year. FI 2027, EPS picks up to about 2.63 cents. The parrot clinics are maturing. New openings contribute. The KL Medical Centre is under construction, but not yet generating revenue. FI 2028, this is where it gets exciting. If the new KL Medical Centre opens on schedule and ramps well, I estimate EPS could reach 3.23 Singapore cents. That's a 39% improvement from today, at a PE of 20 times, which is conservative for a growing healthcare company. That implies a price of about 65 cents by late 2028. From 0.330 Singapore dollars today, that's close to doubling in 3 years, plus whatever dividends get reinstated. That's the bull case. The bear case, if KL is delayed and margins stay compressed, is more like 2.50 cents by FI 2028. So here's my final verdict on ISEC Healthcare using the JC Fund framework. Pass, monitor. The stock has a 38.8% margin of safety to my base fair value. That exceeds my minimum threshold of 30%. The balance sheet is clean, net cash. 5 consecutive years of revenue growth. Strong operating cash flow. The economic moats are real, if not bulletproof. The two things I am monitoring closely. First, Q2 2026 results. Do gross margins recover, or is the doctor pay compression structural? This is critical. If margins recover to 44 to 45%, the thesis is intact. If they stay at 42%, earnings need to be revised down. Second, the KL Medical Centre construction updates. Any delays, any cost overruns, any change in the 2027 timeline. I want to know immediately. My action. Initiate position at current levels around 0.330 Singapore dollars. Consider adding more if the stock falls below 30 cents. That would represent a 44% discount to my fair value. Review and reassess on the Q2 2026 results announcement. And that's a wrap on my ISEC Healthcare Deep Dive. To summarize in one sentence, a high-quality Southeast Asian eye care chain trading at a significant discount to fair value with one major catalyst, the new KL Medical Centre, that the market seems to be ignoring. If you found this useful, please hit the like button. It genuinely helps this channel reach more people who are on the path to financial independence. Subscribe if you haven't already, and hit the notification bell so you don't miss the next deep dive. Drop a comment below and tell me what company you want to analyze next. This is JC Project Freedom. I'll see you in the next one.